Mr. President, I've come to the floor to discuss the tax extension package before us. I support this package because it will provide, I believe, a significant boost to the economy next year. It is necessary because the alternative would be a significant tax increase on millions of middle-class families in just a matter of weeks. Mr. President, I recognize that this package will increase the deficit over the next 2 years, but we need to distinguish between what is the right economic policy short-term and longer-term. Short-term, I don't think there is any question that this economy remains weak, unemployment stubbornly high, and that means we need to do more to provide liquidity in the short term. That does not mean that we should ignore the growing debt that is all around us. That is a longer-term challenge, but it requires our urgent attention. Mr. President, we need to put together a plan this year to deal with our deficits and debt. That's what the Fiscal Commission was all about, that Senator Gregg and I pushed for, which has just recently concluded its work with 11 of the 18 members endorsing a plan to reduce our debt long-term by $4 trillion. And Mr. President, just as with that package, there are not all elements of this package with which I agree. In fact, part of this tax package I strongly oppose. Most notably, I am opposed to those provisions that give, I think, overly generous tax reductions to the wealthiest among us in the estate tax area. But I understand that the President did what he had to do to get an agreement. This economy clearly remains in a fragile state, and we can't afford to wait until we get everything we want. We cannot let the perfect be the enemy of the good. And Mr. President, too often in this chamber, in this Congress, people insist on having it their way or take the highway. And unfortunately, that prevents us from doing things that are absolutely essential for the nation. Mr. President, economists project that a failure to pass this package could reduce economic growth next year by as much as 50%. That would mean millions of jobs, Mr. President. So those who say, well, let's just scuttle this, they got to think very carefully. What is the risk to the economy of the United States? Mr. President, just to review where we've come from, the federal response to the recession and the financial crisis, I believe, has successfully pulled this economy back from the brink. We were headed, I believe, for financial collapse. Economic growth has returned, not as robustly as we would have liked, but nonetheless it has returned. In the fourth quarter of 2008, lest we forget, economic growth was a negative 6.8%. In the most recent quarter, it was a positive 2.5%. That is a remarkable turnaround. And the same can be seen on the jobs front. In January of 2009, this economy lost over 800,000 private sector jobs in 1 month. The next month, we lost another 700,000 jobs. The next month, another 700,000. The next month, almost 650,000. Now we fast forward to today, November of 2010, 50,000 jobs were created. That is a dramatic turnaround, and we can see for month after month after month, we now have positive job growth. But Mr. President, this economy has turned in the right direction and done so in quite a dramatic way. We've also seen the rebound in the markets. The stock market hit a low of 6,547 back on March 9th of 2009. We're now well over 11,000. So on economic growth, on job creation, in the stock market, we have seen dramatic improvements, I think as a direct result of things that were quite unpopular. The TARP program, the stimulus program. But Mr. President, this economy still remains too weak too fragile. Unemployment stubbornly high at 9.8%. By the way, without TARP, without stimulus, the best economists in this country, including Alan Blinder, the former deputy chairman of the Fed, and the chief economist at Moody's, Mark Zandi, said without TARP, without stimulus, unemployment today would be 15%. 8 million more people would be out of work. So, Mr. President, despite some who say these haven't worked, TARP and stimulus, I believe the evidence is quite clear. They have worked. But more needs to be done. As we enter the holiday season, we can't forget that 1 in 6 Americans is now unemployed or underemployed. And so we must do more to create jobs. In a recent speech to the European Central Bank, Federal Reserve Chairman Bernanke went about as far as he could go on the question of fiscal policy. And he urged Congress to do more to help the near-term economy, while at the same time taking steps to bring down long-term deficits. Here's what he said. On its current economic trajectory, the United States runs the risk of seeing millions of workers unemployed or underemployed for many years. As a society, we should find that outcome unacceptable. Monetary policy is working in support of both economic recovery and price stability. But there are limits to what can be achieved by the central bank alone. A fiscal program that combines near-term measures to enhance growth with strong confidence-inducing steps to reduce longer-term structural deficits would be an important complement to the policies of the Federal Reserve. The chairman, I think, has it right. He is clearly saying the Fed alone is not, and their actions are not enough to keep the recovery going. Congress also needs to act. It needs to act in the near term by taking steps to generate economic growth, and it needs to act on the long-term challenge by putting in place a plan to bring down deficits and debt in the medium term and in the longer term. This package, the one before us, will ensure that middle-class taxpayers are not hit with a tax increase at the start of the year. It extends for 2 years, all of the 2001 and 2003 tax cuts. And by the way, by far the most important thing for the economy is the middle-class tax cuts. That is what is critically important to the economy. The tax cuts for the high end, we could either do or not do. They're mildly stimulative, but according to CBO, they have pretty low bang for the buck in terms of economic growth. That's the high-end tax cuts. Pretty low bang for the buck, according to the Congressional Budget Office. This package also has expanded child tax credit and earned income tax credit for working families, the American Opportunity Tax Credit for college expenses, the alternative minimum tax fix. Otherwise, millions of people would be getting a tax hike completely unintended, and the R&D tax credit and other expiring tax provisions. So, Mr. President, this package, as a package, according to the best economic advice that we can get, will help economic growth, will help job creation, create as many as 2 million additional jobs in the private sector next year. The package also includes 3 critical measures to help the economy. It includes a payroll tax cut for working families. This will provide a 2 percentage point reduction in employees' Social Security payroll taxes. A worker with $40,000 in income would save $800. This measure is widely recognized as one of the most effective ways to boost near-term growth. In fact, I asked CBO last year, what are the most effective steps we could take to promote economic growth? Number 1, interestingly enough, extend unemployment insurance. That's in this package. Number 2, a payroll tax holiday. That's in this package. In fact, as I indicated, this package has an extension of unemployment insurance benefits at their current level for 13 months. This will prevent 7 million workers from losing unemployment in 2011. Economists also rank this measure as high on bang for the buck, as I indicated. It also includes a business expensing provision allowing businesses to write off 100% of capital purchases in 2011. This is a useful incentive to get businesses to start spending again and could generate more than $50 billion in additional investment in 2011. And again, CBO rated this measure as high on bang for the buck. Here are some of the examples of the tax cut benefits provided by this package. A mother with one child with $20,000 of income will receive an $1,100 tax cut. A married couple with $40,000 of income will receive a tax cut of almost $2,000. And a married couple with two children with $60,000 of income will receive a tax cut of more than $3,300. Mr. President, Mark Zandi, the chief economist for Moody's, former advisor to Senator McCain's presidential campaign, has examined the potential economic impact of this package. Here's what he concluded. The fiscal policy compromise will be good for the economy next year. The planned temporary tax cuts and spending increases will provide a substantial boost to growth in 2011, ensuring that the still fragile economic recovery evolves into a self-sustaining economic expansion. The deal's surprisingly broad scope meaningfully changes the near-term economic outlook. That, according to Mark Zandi, the chief economist for Moody's. Mr. President, for those who are concerned about the deficit, as I am, job one is to get this economy growing more strongly. That is job one. Then we've got to pivot and deal with a long-term plan to deal with the deficits and the debt. As I noted before, the one provision in this package that I am particularly unhappy with is the estate tax provision. I support the continuation of the 2009 level with an estate tax exemption of $3.5 million for an individual, that'd be $7 million for a couple, and a rate of 45%. At those levels, only 1/4% of estates would be subject to any estate tax in 2011. 1/4% of estates would be affected. That means 99.75% of estates would be exempt from any estate tax under the levels that I am proposing and did propose in the budget. Unfortunately, under the compromise package, certain of our colleagues on the other side insisted that the exemption level be raised to $5 million for individuals or $10 million for a couple with a rate of 35%. This will reduce the number of estates subject to the estate tax to 1/7 of 1%. It adds about $20 billion to the cost of the package over 2 years, and it will do absolutely nothing to generate economic growth and to create jobs, according to the economic analysis made available to us. If made permanent, this provision would add $100 billion in lost revenue to the Treasury over the next 10 years. $100 billion more than the package that I proposed. I don't think that's fiscally responsible. I don't think it's wise. And I don't think it should be approved. While we need to pass the overall package to give a near-term boost to the economy, we must also now pivot to deal with the nation's growing debt. Gross federal debt is already expected to reach 100% of the gross domestic product of this country in 2011, well above the 90% threshold that many economists see as the danger zone. One of our nation's leading economists, Dr. Carmen Reinhart, came before the President's Fiscal Commission. She had recently co-authored a study of the impact of debt on more than 20 countries over the last 200 years. She concluded that when government debt as a share of the economy exceeds 90%, economic growth tends to be about 1 point lower than if debt levels were not so high. But don't be misled by 1 point lower. That sounds like nothing. If the economy is growing typically at 3.5%, 1 point less would be about 1/3 less economic growth. So we need to understand the consequences of debt are lower economic growth for the future. Mr. President, our long-term debt outlook is even more serious. According to the Congressional Budget Office, federal debt could rise on the current trend to almost 400% of GDP by 2054. That is a completely unsustainable course. I personally believe the deficit and debt reduction plan assembled by the President's Fiscal Commission, on which I served, could prove a way forward. Even though the plan did not receive the necessary 14 of the 18 votes on the Commission to guarantee a vote in Congress, it did receive the support of 11 of the 18 Commission members, which is more than 60% of the panel. 60% here, we can pass anything. But on our Commission, we required 14 of 18 of the commissioners to agree to assure a vote in Congress this year. And by the way, the 11 who supported the plan was completely bipartisan. 5 Democrats, 5 Republicans, and 1 independent. That outcome proved that Democrats and Republicans can come together to solve this challenge. Here's a quick overview of the Fiscal Commission plan. It provides nearly $4 trillion in deficit reduction over the next 10 years. It lowers the deficit from 8% of GDP in 2011 to 2.3% in 2015 and 1.2% in 2020. It stabilizes the debt by 2014 and then lowers it to 60% of GDP by 2023 and 40% of GDP by 2035. It reforms Social Security to ensure its solvency for at least 75 years and puts the program on a more sustainable path beyond the next 75 years. And it includes fundamental tax reform, making the tax code simpler, fairer, and more efficient, while also raising more revenue for deficit reduction. So now we have a responsible and realistic bipartisan plan on the table, and national attention is focused on the issue. It's up to Congress and the President to finish the job. Mr. President, tax reform may be the most important component of the Fiscal Commission plan. Here are the key elements included in the Fiscal Commission plan. 1, it eliminates or scales back tax expenditures that are currently running $1.1 trillion a year and lowers tax rates. That will promote economic growth and dramatically improve America's global competitiveness. And it makes the tax code more progressive. The Commission's illustrative tax reform plan demonstrates how eliminating or scaling back tax expenditures can lower rates. Mr. President, this plan is a beginning. It's got to become law in order to have its full effect. Mr. President, I hope very much our colleagues will consider supporting this plan, the tax plan before us, and the deficit reduction plan that needs to be an integral component of a long-term fiscal plan for the nation. I thank the Chair and yield the floor.